Hello friends, in the series on the income tax cases, today we will discuss an issue which is related to a very pertinent question that if the assessee received some compensation for terminating the contracts which have never started is a capital receipt or a revenue receipt. This issue has been taken up by Delhi इ.T.A G bench in the case of Assistant Commissioner of Income Tax versus UK Paints India Limited and vice versa. This case is reported in 2025 131 Ι.Τ.Α Tribunal at page number 74 and the date of the judgment is 16th June 2023. The present case relates to the assessment year 2008-9 and assessment year 14-15, and the facts of the case are like this: that the assessee has never been into the business of insurance, and the assessee and the two banks entered into a share subscription agreement with a P group to establish a company for the purpose of conducting the life insurance business subject to the various regulatory approvals. Generally, it has been seen that the approvals in the case of insurance business are given on a very selective basis, and in the present case also the company was not able to approve or get the approvals from the regulatory authorities. So, since in the absence of approvals the joint venture cannot work, so in the present case P exercised its option and acquired the shares of the assessee and gave a liquidated damages for the assessee of rupees 4.34 crore. When the assessee filed the return of income, the assessee claimed this payment as a capital receipt. But when the assessment proceedings were going on, the assessing officer was of the view that the assessee is liable to short-term capital gain according to section 55 subsection 2 clause A. Section 55 talks about the indexed cost of acquisition or indexed cost of improvement, and accordingly the assessing officer treated that amount as a short-term capital gain. When this matter was before the CIT appeal, the CIT appeal was of the view that in the present case, whatever the payment has been received by the assessee for foregoing its rights, that payment is not for the transaction of only one or more rights, but it is for the bundle of the rights which have been foregone by the assessee. The CIT appeal said that in the present case, the entire profit making process was impaired by the assessee. So, in the present case, the nature of the payment which has been received by the assessee, it is like liquidated damages, and it cannot be said that it is a revenue receipt. The CIT appeal also said that in the present case, the facts of the case suggest that the assessee has never been into the business of the insurance. So, whatever the payment has been received as a compensation for terminating the contracts which have never started is a capital receipt, and it is also very clear from the facts of the case that the genuineness of the transaction is also not in doubt. So, in the present case, the CIT appeal gave relief to the assessee. So, when this matter came before the tribunal said that in the present case, it is very clear that there is no fallacy in the findings of the learned CIT appeal, and from the facts of the case, since the assessee was not able to even kick-start the business was terminated before the start of the business, the approvals were not received. So, if the assessee exercised its option and have foregone its share capital in favor of the other partner, so in that case, whatever the compensation has been received by the assessee is a capital receipt. At the end of this video, once again I am repeating the name of the case. The name of the case is Assistant Commissioner of Income Tax versus UK Paints India Limited, UK Paints India Private Limited and vice versa. And this case is reported in 131 Ι.Τ.Α. Tribunal at page number 74, and the date of the judgment is 16th June 2023. Thank you, friends.